All right, ladies and gentlemen, welcome back to the fastest growing life insurance podcast on YouTube, Apple Podcasts. We're not on the airwaves yet, but if you're a radio station that want to pick us up, I'm easy to get a hold of. Hit me up. We'd love to be on the radio. I'm here with Dom Rufran. My name's Caleb Guilliams. And for today's episode, we're going to be responding to literally the world's longest comment. I'm assuming this is a legit comment because Joel, our producer, doesn't mess around with this kind of stuff. I have not read this yet. And so we're going to go through this in real time. For those of you that know my ability to read is lacking at times. So I apologize in advance if we're stumbling through this, but I think it's important that we can address um, comments. And it sounds like this person is putting together a pretty anti-post. And I think it's instead of me writing back, which would take me a long time, we are like, why don't we just dedicate an episode and go down this whole rabbit hole? So anything that you want to mention, Dom, before we jump in, because I don't know if you've taken the time to read this, but I think what we should do is just read, and then as we want to point out things, we point out things, and we'll see where this leads us.
Amazing. What I just did, guys, is I actually took this whole comment and plugged it into ChatGPT and told it to summarize it to give it like some better talking points. And so we could use that as a framework if we want to, or we could, keep the inherent nature of the actual comment and look at the whole thing.
Why don't you read the summary? But let's actually address it paragraph by paragraph. But why don't you read the summary before we jump in?
Cool. So the core claim is infinite banking is portrayed as a sales tactic to push whole life insurance, mainly to generate commissions, when you could replicate this with a strategy using a regular bank account. IBC isn't unique. Something you can do with your savings account, like mentioned. It's very costly up front. More control with your own account. You decide how much to borrow, repay, and what interest to charge, even if it's 0%. Liquidity and simplicity. Bank accounts are fully liquid, no surrender charges, no waiting years, no access funds, no complexity like MEC limits or policy structure. Same benefits without insurance. Loans are always tax-free, not unique to life insurance. Better economics in their view. Interest you pay back goes to you, not an insurance company. No compounding loan interest working against you. So, death benefit critique, whole life combined savings plus insurance and efficiency, cheaper term insurance. So buy term invest difference. Bottom line, you can be your own bank more efficiently, cheaply, and flexible by using high yield savings account instead of whole life insurance.
Cool. We'll dive into that all and more. So here we go. We got Mark F. 2050. Love it. And Mark, I think we've multiple times have responded to you and said you're welcome to come on the show. And I think at this point you've declined to come on, but that's okay. If you want to come on sometime, you're more than welcome to. So here's what he said. I guess I'm assuming it's a he this is what this person said. Infinite banking is just a ploy to get you to buy whole life insurance and generate thousands in commissions and fees. The concept is very simple in that you create and fund an account that you can borrow money from and pretend that it is your bank. There is an alternative secret strategy that allows you to truly take control of every aspect of the banking process. You control how the capital is invested, how much you take as a loan, even up to 100%, how to repay the loans, even never, and how much interest to pay on the loans, even 0%. We're just going to keep moving on. I think he's trying to talk about the pitch of infinite banking, which I would talk a lot differently, but I think we can address that at the end. The secret that whole life insurance salesmen and women, I think we need to include our women in our industry as well, will never tell you is that instead of paying dearly to the insurance company to create your cash value capital, you can fund your own savings or investment account and use that as your collateral, which is true. If infinite banking is what you want to do, here is how and why you can practice infinite banking much more effectively with your savings account at a high yield online bank. Okay, let's learn here. Your bank says, let's say it's Allies, for example, does not need a salesman to sell you your account. Your bank, where you store your cash, will not charge any commissions or fees. You'll break even on day one, which is true, not year 7. At your bank, 100% of your deposits is credited to your account. Ask your whole life agent how much of your premium is credited to your cash value in the first few years. Your bank will not convert your cash into cash value. It will remain your cash. Your bank account has no MEC limits. So far, so good. I mean, he's saying year 7, obviously we can have policies that break even way closer to that. But I think in any solid illustration or policy that we'll come up with, we'll have anywhere from like 70% cash value to maybe low 90% cash value. And so there is for sure a claim, it's 100% accurate, that your bank account will have earlier liquidity, way more flexibility early on. I don't think anyone's debating that. Your money in the bank is safe and FDIC insured, which is could be a whole episode in itself, is what is FDIC insurance. But you're right, up to 250,000 in a lot of cases. Some banks have greater limits, and so I think that's important to know. Your bank has no fees to sap the effective interest rate. At your bank, if you want some of your money, just request it and they'll give it to you, and it will be tax free. No, it won't. It's obviously, if you put in your money after taxes, you can take out your money after taxes, but technically any interest that you grow in a checking account, high yield savings account, CD, is taxed at ordinary income tax. So
he's talking about it if you were to collateralize and leverage it in that context.
Okay. Where did he say that? If you want some of your money, just request it and they'll give it to you and it will be
well,
tax free. I don't hear anything about a collateral.
Well, I just think that if you use the top section of it, of what he's using, is like, hey, you can use the same strategy with infinite banking, but with your bank account, and you can collateralize it and leverage it. Like he's just playing like point to point to point to point, like assuming that that's staying standard.
Okay, so that's one of the things that we'll address, because in a high yield savings account, I'll see if he makes any interest rate claims. But and again, a common thing that's going to be brought up, you can say the same thing on whole life. This is going to be the claim, is if you put your money in a high yield savings account, let's say you earn 3%, and you're getting charged 6%. There's zero arbitrage. You'd be way better off financially taking that money and paying cash than collateralizing it. You could say the same thing with whole life. Is like, well, Caleb, if you're only earning 4.5% to 5% in your whole life and it costs you 6%, the same negative arbitrage happens, which is correct. So then the next question is, what other benefits do you want to factor in to the equation? And if the benefits don't outweigh the cost of borrowing, then you should not do the strategy. Just newsflash for everyone. Like, I'm very consistent with that. Whereas in a high yield savings account, it would be pretty dumb to put your money in a high yield savings account and then collateralize. So just pointing that out. So if they give you money from your account, there is no need to pay it back to your account, which is true. But you can, if you want to, at 0% or any interest you choose. So that's true. If you take your money out, you can put it back. There's no interest that's being charged. Yes, with this strategy, you are truly the bank. You set the interest rate and you keep the interest. At your bank, if you pay yourself back at the same rate, you would pay back a policy loan. You'll come out ahead in cash compared to your cash value with uninterrupted compounding. So he's essentially saying, if you take money from your savings account and then pay yourself back at quote unquote 6%, let's just say, over time, you're going to have more cash value in that equation than your cash value, because that 6% is actually going to the insurance company. And let's say you're earning, let's say 4 or 5%. So from a cash on cash standpoint, that can remain true, where the difference would be is if you're only earning 2% or so, there could be some differences there. But from a pure mathematics standpoint, that this person's not wrong with that claim. That's because the interest portion goes into your account instead of the insurance company, and do the compounding growth, which is a unique feature of cash value. So yeah, he just said what I said. If you don't pay back a loan to yourself, there are no compound interest charges against your account. True. At your bank, if you want to close your account, they'll give you 100% of your funds with no surrender fees. About 80% of whole life policies end up surrendering their policies early. Don't know where he gets that claim at all. I don't think that's true at all. So I think that that's just a bad claim, and source it and make sure that you're talking about whole life and not just all insurances and all. So just want to point that out. At your bank, you'll earn taxable interest. Okay, thank you. And that's because your account experiences real growth of money you can really spend, and you can pull out more than you put in. The same could apply to cash value, infinite banks, but you're likely to ever pull out more than you put in, which is okay. That's a talking point, um, but I I don't know what to say other than it sounds like an opinion. Uh, at your bank, if you want to an actual bank loan, you won't have to self fund it first or wait years to build up sufficient cash value. At your bank, loans are tax free. All loans everywhere are tax free, which is true. That's the point that you're making, Dom. At your bank, if you take out a loan, the maximum amount is not tied to some percentage of your savings account. Dom, what does he mean by this paragraph? At your bank, if you take out a loan, the maximum amount is not tied to some percentage of your savings account. So you're saying like you could take out more at a bank than you're not, because most banks don't like let you just borrow against your cash value, because again that would be financially not smart for most people to do.
Yeah, I think it's saying like the insurance companies only allow you to borrow a certain percentage of your total cash value, right? You know how you like the surrender charges, like we look at IULs, it's got the account value, surrender value. You can only actually borrow so much of it versus your bank account, you can borrow the full amount of it.
Okay. And then also, just because you use whole life insurance doesn't make you not be able to use banks. So if there's a talking point that says, oh, banks can give you loans that are greater than your cash or cash value, that's like across the board. I would agree, and I'm not anti-banks. At your bank, if you take out a loan, your savings account continues to earn interest unaffected by the loan. Wow, just like with the policy loans. At your bank, if you die, the bank will not keep the funds in your account. Your designated primary or secondary beneficiaries get all of it. Do you know what happens to your cash value when you die? It goes poof. We've addressed this idea of your cash value going away so many times on this show. I will just continue to repeat it. Yes, you get the death benefit, the net death benefit, which gets paid income tax free. And in every case, especially if you're looking at an max funded case, the net death benefit is far greater than the the original death benefit plus all the premiums that you put in. So you could say they take your cash value, they take your cash value, they take your cash value, but the end result is that's not true. That's not true, and it's just a talking point that unfortunately is a poor talking point, especially if you're coming on, like if you're coming at our channel, like every illustration that we design and show, that talking point does not remain true. Your bank will not provide a death benefit. OMG, if a death benefit is important to you, and it is for many younger folks with financial obligations, you can get a term policy at 15 or 20 times less cost compared to a whole life. At 60 and beyond, you shouldn't need life insurance any longer unless your 30 years old son is still living and playing video games in your basement. Most people have no idea where to start or how to really evaluate whole life insurance. That's why we've built the Vault. It's all of our best life insurance resources and educational tools all in one place, all for free. We have calculators, handbooks, crash course, deep dive videos on numbers. If you want to learn more, click the link in the description or tag comment below to unlock the vault. All right, back to the video. Okay, Dom, I'll let you share some things. I'm going to actually pull up something and I'm just going to like try to summarize this entire thing. And I'm going to try to talk about all of its talking points, but I'm going to hopefully do it in a maybe cleaner way than how this was written out.
Amazing. So first and foremost, I appreciate the sentiment and all of the stuff that he actually shared. There's a lot in there that, you know, even while you're reading through, you're like, yep, that's correct. That's true. And where I think that there's a lot of that could make sense. There's some things in there that I don't inherently agree with, specifically the very, very end. I think we underutilize the power behind a permanent death benefit for a long period of time, even after your 60 years old. There's so many strategies around that, from estate planning, from tax advantages that come with it, through pay down strategies, which allow you to actually have more income, the volatility buffer. We talk about the utility of having your asset-based accounts like in the market, buy term, invest the difference, quote unquote person, versus having the investments into the account of the market and having the whole life insurance, and be able to use something like whole life when your assets are down. Because in this strategy that he's referring to and talking about, like, he's still got to go invest these dollars somewhere, right? He can't just leave the dollars in the savings account and just, call it a day. So we're actually talking about the long-term utilization and growth of this account over a 30, 40-year window. And I think that's what's being miscalculated, is that the overall growth on your savings account is also going to fluctuate. There's times where literally for a 10, 20-year window where the savings accounts literally were less than 1%. Even in a high yield account, like, it's like 1%. And so you're getting the long-term benefits of more close to 4 to 5% with guarantees and consistency. You can better plan for what the future holds than wondering what interest rates will be like, how the economic environment will be. And then there's other things like for privatization and credit protection and other things like that are also not factored in from some of the other benefits. So I'm not going to say, hey, like, this guy's wrong and like this is not things that you should do, but I think that there's some overemphasized points, and specifically even on like the commission side of it. This is something that I think it's over shouted from the rooftops way too often. I was literally just looking at that this morning of like, okay, like, what is the actual sheer dollar amount that somebody may put in on premium? So let's say they put in $10,000 per year of like actual commissions that a person would get. And the argument is that the person would get 50 to 90% commissions plus. But in reality, when you design it a specific way that's designed for a higher early cash value, you're actually only getting like 14% of total commissions versus the amount of dollars that you're putting in. So commissions are actually extremely low when it comes to a strategy like this as well. So I just think that some things in here are factually correct, and which I appreciate, but then there's some things that are overfabricated to some degree or another that doesn't give the full story across the board.
Yeah, there's a lot of different talking points, but this person's using the just use your savings account versus life insurance. And so that's what we're going to address. I also just want to say this: neither Dom or I are anti checking or savings account. I will speak for myself personally. I have probably a lot more money than most people in a high yield savings account. I don't say that as like a brag standpoint. I'm just pointing that out to say I'm not anti-banks at all. I think liquidity is important. I'm not going to put all my liquidity in insurance. And while I'm in waiting periods, I'm not anti high yield savings account. So I want to, again, re-emphasize that, because I think sometimes you can be put in a box that we're saying put all your money into life insurance. No, and even if you looked at my situation, probably an area of inefficiencies is I probably shouldn't have this much money parked here when you look at the grand scheme of my entire portfolio. So I just want to point that out. I'm the farthest away from being anti-savings, but over a long period of time, the question is it smart to have your money being stored and used in a savings account long period of time? And we'll just lay out why a life insurance policy could be an asset that is better, and better's relative to every person. There's some people that they may choose a savings account is better than a life insurance policy, but all of the points that were made are nothing new. And I apologize for all of you that had to sit through me trying to like read that. But the reason I didn't have to like prep is like there's no talking point new under the sun around a savings account versus life insurance that I have not heard. So here's, in fact, we even have this as like a part of a presentation because it's so, I think it's important that people understand it. So this is person A, they're making money, they're putting money into a savings account, and then they're using that money to invest in businesses, investments, real estate, and whatever you want. And we'll just take out the assumption that you can collateralize your savings account, because you can, but it's mathematically dumb. If I'm earning 3% Dom and I'm being charged 6%, I would much rather take my money out of my savings account and pay it back. That's financially going to be better off. So we're not even going to mention that talking point. It is important that you can collateralize it, but from an efficiency standpoint, you wouldn't want to collateralize a savings account when you could just use it, because by definition of collateralizing it, you're losing liquidity. And so why would you access other people's money with less favorable terms? So I'll just point that out. Okay. So here are the pros to a savings account. It's safe, it's liquid, it's convenient. So it's more convenient than a life insurance policy. It's we'll give it safety. We'll give the FDIC a talking point, and it's super liquid, and you get some growth. Okay. The cons to it is over a long period of time, I think anyone would agree that you're not going to get the type of rates of return that you could get in other accounts, especially investing. It's not tax deductible, so very much just like a life insurance policy, money going in is not tax deductible. Your money doesn't grow tax deferred, so even if you use it as collateral, Dom, you are paying interest. Even if you use it as collateral, you are paying taxes on the interest that is being earned. Whether it comes out of that account or some other account, it's important to know that your interest in your savings account is taxable at ordinary income tax every year, and you don't have special creditor protection. So those would be the straight up cons. Now, the other point that I want to make is, in this scenario, you're putting money in a savings account, you're able to use it. What you're not getting death benefit. So this person over here would have to take some of this money and buy a death benefit if they cared about a death benefit protection. And so that's just a point that I'll point out. Okay, now someone wants to put some of their money into a life insurance policy. Okay, what are the cons to this? We'll go over the cons in a second. You don't have all the money that you put in. Instead of having 100% of your money early on, you might have access to 85% in the first year. So that's important to note. You can still utilize it for the same activities. Yes, you're in a lot of cases borrowing against it because that is the most efficient way in this setup to access that money. But there's nothing special about borrowing. There's nothing magical about borrowing versus withdrawing from a savings account. It's just, from an efficiency standpoint, it's more efficient when you're using life insurance. Now, the difference between pros and cons: a lot more pros in these benefits. Obviously, it's safe. It's easily accessible, so it's less convenient, but you still can access that money. We'll talk about the competitive growth, but there's lots of other things, including creditor protection. It comes with the permanent death benefit. If chronic and terminal illness rider is important, if the permanent death benefit is important, if the fact that your money is growing tax deferred, that you don't have to pay taxes ongoing, all those things are valid. You might not care about it, but you can't. You have to, if you're comparing apples to apples, you have to at least acknowledge that there's other benefits of insurance. You might not care about it, but for people to say, oh, it's a scam and all this stuff, like, okay, at least tell me it's a scam, but acknowledge the other benefits that are being included with this contract. You may not care about it, but there's other benefits that aren't coming with the high yield savings account. The cons: not tax deductible. It takes over 40 years to have more money than what you've put in, and not everyone qualifies from a health perspective. So all the points that he's making outside of the not tax deductible, but he talked about, not having all the money immediately, and I think that's important. Okay, so now let's go into like a life insurance illustration. Over a long period of time, a life insurance IRR in your cash value, in this example, will earn, let's say, 4.5%. So 4.58%. This is from a real illustration over 30 years. And again, someone immediately looking at that will say, that's not super sexy. Investments can outperform that. I agree with all of that. But first, we're not even factoring in any other benefits, Dom. That 4.5% is far greater than the national average of what you could earn in a high yield savings account. We're not even factoring in taxes, but over the last 30 years, a high yield savings account has earned around, like on an average, 2.5%. Right now, at the time of this recording, it's a little bit higher. There's been, when we first got into this space, high yield savings accounts were practically paying zero. So if we take the national average of 2.5%, just immediately, your cash value is earning 4.5%, which is 83% higher than 2.5%. Now, I will still point out, for those of you that are jumping on me in the comments, it would still be dumb if that's all we cared about. If you put your money in an account that's earning 4.5% and you're borrowing at 6%, that still financially is very stupid. You're only earning 4.5% and you're paying 6%. No way mathematically is that justified, or is that a good idea? I'm choosing a savings account all day long if we care about efficiency. The reality is life insurance has other benefits that we need to factor in. So if you factor in taxes, in this example, we're choosing a 30% tax rate. Why? Because when you include federal and state, this is, and you have to assume at the highest tax bracket, this is our assumption. Maybe if you're someone that's not paying any taxes, you have to factor this in. And if you're not paying any taxes, life insurance gets a lot less attractive, in full disclosure. Now you're looking at an equivalent return of 6.5%. So let me ask you this. If we're just looking at the taxable equivalent, and I can earn in a taxable equivalent 6.5%, and I can borrow at 6, boom, that's a 0.5% arbitrage, not cash on cash arbitrage, but value arbitrage. So again, I think it's important to note that and all these other benefits represent all the other benefits that we could get into. Now we'll talk about cost of insurance. This person talked about cost of insurance being a lot cheaper. And so if you just factor in a cost of insurance, which by the way, we ran the math, and over 30 years, you can get an equivalent life insurance policy, and it would cost about 10% of what your original premium would be over 30 years. And now if you factored in not having to pay the term policy, which you're right, is significantly cheaper, your taxable equivalent cost of insurance value is over 7%. Now, again, I'm not saying that 7% is going to knock anyone's socks off, but I am saying that we're just literally tying in the tax equivalent and the cost of insurance, which are two talking points that are made a lot. And boom, now you have a equivalent value of over 7% in this example. And this is where you could say, would I borrow at 6%, let's just say, to earn an equivalent value of 7, and we haven't even factored in all the other benefits, the chronic and terminal illness rider, the fact that you have creditor protection, the fact that this is private, the fact that there's built-in guarantees to this. This is why life insurance could be a solid cash alternative because of all the other benefits that it gives you. And so that's all. I'm not saying all your money should go in there. I'm not saying high yield savings accounts are evil. I'm even saying that the infinite banking talking points, a lot of them are dumb. And that's why we've dedicated a show to calling people out on all this funny math. I'm literally just saying, if I can borrow money at 6 and earn 7, I'm doing that all day long, especially if there's not any risk on the quote unquote 7%. And you're not earning 7%, but when you factor in all the other values, you can easily justify that. And when you factor in taxes to your high yield savings account, that whatever the high yield savings account number is, it goes down. So, Dom, I could have been total in la land, and I might have lost every single person, our viewers, but I think it's important to address. And this is like the number one talking point when we're talking to entrepreneurs or investors. It's like, why would I use life insurance policy over a savings account? If they don't value insurance and the other benefits, they should do high yield savings account all day long. But if they actually value the other benefits that you get in a life insurance contract, I think it's pretty obvious over time that this life insurance contract is going to continue to increase in benefits and value. And then we're not even talking about the strategies that open up long term that nobody talks about, the strategies that open up that potentially could give you greater income, a greater legacy, give you more optionality in the future.
I think the one thing that I know you want to die on your sword by, to be the Steve Jobs of full life insurance, is talking about the multi-use dimensional asset that has many benefits to it. And what I think that our space, especially in infinite banking, becoming your own banker, focus so much on is one thing in an isolated bucket, which is the internal rate of return, the rate of return, the growth on the cash value, the how much you have in year one versus year, like all of those other factors. And I think what you're saying is, when we look at this presentation, we look at your talking points, is that whole life insurance, when looking at a holistic approach, it is one of few assets besides maybe real estate that can truly actually give your dollar more than one purpose. And when you have an asset that can give your dollar more than one purpose, more than one job, it becomes a benefit that can enhance everything else. It's not the one golden ticket to your financial freedom. It's the thing that can help make everything else better. And if we can mentally think about it that way, well, then this asset becomes an amazing asset that we're no longer having to compare to. We just say, okay, well, let's utilize this to make our portfolio stronger, more robust, more risk adverse, allowing life to happen. And if life does happen, we have plans to essentially protect that. And that's why this asset becomes so profound when you really understand it, not chasing a rate of return at the end of the day.
Yeah. Well said. I look forward to hearing people's thoughts in the comments, because I genuinely actually agree with a lot of people attacking infinite banking, because the infinite banking talking points, that usually the talking points are compound interest is better than amortized interest, blah blah blah. And we've had that discussion on this show, and that's like, mathematically that does not hold water. If you're earning less than what you're borrowing, it's not a good equation. Won't compound well. But a lot of times you're giving all the benefits of a high yield savings account, and you're not even factoring in the taxes in that. And then you're comparing life insurance, and usually the most negative light. And you wonder, like, why do people do this? And then it's like, why do banks do this? Why do corporations do this? Why do successful people do this? Are they all stupid? Are they all like getting scammed? Or are they using this in a way that maybe we don't understand? Now, they do have higher taxes that they have to deal with, and they do have legacy that they care about. And life insurance obviously thrives in both of those and looks better. Obviously, Dom, if someone's at a 10% tax bracket, this is going to look a lot different than a 30%. You would still run the numbers, but I'll be the first to acknowledge that permanent life insurance is not for everyone, and shouldn't be necessarily the first place that people go in their financial life. So I thought you did a great job summarizing. Anything you want to say before we sail off?
No, what I'll say at the end in regards to just holistically is I want to say thank you to the person who made this comment. You constantly challenge myself, Caleb, the industry. If everybody just believed constantly in like one thing, then we wouldn't essentially be getting better. And so I'm grateful for the conversation. I'm grateful for the dialogue. And I think we can probably agree, if you are open-minded, is that not all one thing is the greatest thing for all people. And there's different strategies for different people based off of different goals. And by really diving into what somebody really wants out of life is really where it stems from. And then you can play in these strategies accordingly. So,
yeah, well said. Well said. Thanks, Dom.